What's up, Outliers? Quick market update, bit of a day out there. We don't have a live stream today. We're running a new cadence. The live streams will be Tuesday and Thursday. So we'll run a couple of these market updates in the meantime to tide us over. So what happened today? Pretty big market reversal. The market was down a pretty solid portion of the day. And then towards the tail end, it started to rotate back over. So we take a look at futures here. This is just the micro E-minis. You can see that through most of last week, started off down, opened up today, 13th, and we opened up really soft and we were rolling down through this, and then we got bid back up. That was very curious to me. So if we grab SPX instead, which will have a little bit more follow through, you'll notice the size of the candles here is very different. It's just because there's more transactions going on in here in the index itself via options and whatnot. So, I mean, this is still objectively a lower low. Even though it didn't fall out of bed here, I don't think we're out of the woods. This still looks like the level to be beat to the downside. And I think if we continue to see this downward pressure, because it wasn't a great follow through day to the upside, it barely crossed above the close from Friday. So this is still rolling over and it's developing a channel to the downside, right? So we're seeing successive lower highs, successive lower lows, except for this one. But now this one adding in starts to build that out. So it's kind of anybody's guess at this point. And that's the cool part about trading is we don't really have to know. We just have to follow what it's doing and move along with it as best we can. So volatility contracted quite a lot. It opened up heavy today, up over the 20 handle, and it fell down below 19. Now, this is typically a great spot to start considering if you trade volatility. Some trades in here, you can either trade it the non-traditional way, I guess you could say, and sell puts. The reason why you might sell puts into something like this is because the volatility will be very high, and then you might get out even as it contracts towards the puts slightly unscathed because of IV contracting, and then you kind of protect your risk to the downside a little bit. You could always do long puts. Going to be really expensive. You're not going to make a whole lot on it on a relative basis, but directionally it tends to work again, because you can see over the last 6 months, we don't get many runs up above 20. And when we do see runs up above 20, they're not that long in duration. Even if we go all the way back to the drop that we saw in August of last year, you can see that we were above 20 here. 1, 2, 3, 4, 5, 6 days. And then on the 7th, no, I'm just kidding. On the 7th, VIX rested apparently and dropped below 20 for a little bit. So that's a typically simple trade. It's not like you're going to make a bunch of money on it because everybody knows it, but it still is at least something to pay attention to. Looking across the broader market, though, let's grab the indices first. And actually, let's grab the overall market. And we can see a few things. I want to run through a couple positions in a second that I updated in TQQQs and in UPRO, the covered strangles, because today was a day to start making some adjustments to those, and I want to keep you up to speed with what's going on. But across the sectors, we saw materials is starting to base out here, right? So it actually had a pretty strong day on the day, and it's posting a channel, not a channel, sorry. It's posting local lows, meaning it's not falling, it's not continuing, it's starting to consolidate. So it's turning into a consolidation trend, whereas comm services is still decelerating. It bid up slightly today, but not much. And then energy is still continuing its run. Energy is likely to continue to look good during this kind of market condition. Then we have financials, about the same recovery, but none too strong. And it's still assuming this downtrend as far as we can see now. Industrials, this is consolidating and potentially starting a trend reversal, a little early to tell. Tech fell out of bed, right? So even though it had an okay up day, it still gapped down, which is a pretty big move. I know because of, TQQQs. Staples. Lows, new lows. This has been an easy trade to continue to follow. We've talked about this for literally months now, like at least 2 months. We've been talking about staples, and it continues to show weakness. Real estate, again, maybe slightly consolidating, but it's still too early to tell if that's local lows or if it's just an update that's likely to continue. Utilities, down day. It's not looking healthy. Healthcare is, again, rallying a little bit. It's kind of the stronger, I guess you could say, between energy and healthcare, but neither one of them look great. And then discretionary is still downtrending. So for those that are wondering, this is defense, and defense is consolidating for some time now. So across the market, breadth doesn't look super great. Now, we did see that turnaround today, so it led to more names advancing than I would have expected, and we can see the change in the 5-day and 1-month advancers decliners for the total market components. So the market is still rotating over. That's what this tells me. It's too early to call it heads or tails in either way, but I do think having some sort of long inverse deltas is probably not off the table. So when I say long inverse deltas, it's essentially beta weighted deltas that are negative that were long. And the reason why I say long is just because it controls risk a little bit more than being overall short options into that. So the easier way to think of it is just being short beta weighted deltas, but using some sort of long premium strategy. That is essentially what we're seeing across the market today. Now, from an economics perspective, we had a few things come out that were absolutely important. So CPI came in light. It was expected at 5.3, came in at 5.22, which is not actually super great. Inflation expectations came in pretty close to expectations. And then CPI, we have to take a look at year over year and month over month. So we'll jump on that in a second. But first, I just want to pop over and see from a broad market perspective what news is being highlighted here. So this is through bar chart, just coming through and seeing what they're flagging. NASDAQ down, we know. Crude oil, yeah, there's a relationship, but that's been a little bit weaker. So this is definitely a big focus right now is CPI coming out Wednesday. We can see from a Fed rate cut perspective, there's been really no change in the expectation of no change. So there's not a lot changing here, to use the word 3 times in a row, but there really isn't, right? So if we look at a day ago, it was 96.8% chance of no change, and now it's 97.3, right? So the market's not expecting a change in 29 March or 29 Jan. If we look in 19 March, it's still higher probability of no change. And then if we look at 7 May, it's still highest probability of no change. And then if we go all the way out to 18 June, that's when we get a slight edge on a potential ease. So one of the things I really like to do is track this, because you can see the near-term changes in expectations happening real time in other levels of expectation. So you can see from the 9th of Jan, specifically looking at the blue line that I'm hovering on, for the federal fund rate to be targeted at 4.25 to 4.5, it's at 27%, and then it jumps to 44. So there's still, again, like a lot of changing underlying expectations and what this might look like, but it's all centered around very little overall impact likely to happen here. All right, so let's take a look now at a couple changes that we had today in the leveraged coverage Strangle portfolio. So today we're going to talk about TQs and UPRO. And you can see I'm still very light in both of these. We actually took some risk off today in the sense of when we were rolling some in the money short puts, we got much better strikes, which decreases the total amount of cash secured requirement for the position. So then that ends up decreasing our utilization, even though the position size you'll notice will be the same. To summarize what I just said, I didn't change any of the lot sizes, but because the strikes did change, the overall amount of money I need to cash secure it decreased, which decreases the total utilization, thus the percent utilization. This is a tactical move at this point because I don't really care for what the market is sitting at right now. Again, I don't think it's end of days, anything like that, but this isn't where I want to be overexposed, which is why I'm so light on these two, sub 50%. And I will stay this way as long as I need to. The other thing that you'll notice, it's not, sorry, it's not on this one, it's on another one that I track that will monitor the notional exposure. But remember, TQs and UPRO, they're essentially both 3 times the underlying itself. So this is essentially behaving as $300,000 a SPY, and then this is essentially behaving as 120-ish K of TQs. So it's already levered. That's why I don't need to add too much risk here. It's one of the benefits of trading this strategy. Okay, so what changed today? Well, pretty easy stuff. In TQs, don't have a lot out, but I did have this position, and it was expiring this coming Friday. I had the 82s, the 82 puts, and these were already rolled once. So you can see I took those down. This was, I think, a little while ago, if I'm not mistaken, that I originally adjusted this roll and I flattened out. This was the call side, sorry. I had flattened out the call side, and then the main adjustments came on the put side, because here's what happened. I originally just took in these 83s for a small bit of profit to reposition and break out the lots to be in a couple different expirations. And this was also just taking some of the risk down. I had talked about that. So then the primary adjustment today was in this trade where we were almost on to expiration. I had the 83 puts that were expiring 17 Jan. They were originally a 30 delta. I took them down. Obviously, they were in the money by a bit. They were like a 70 delta. I took those in for 825. And then I offered this tranche here for 850. So I didn't change size, but I did improve my basis by 3 points. There's a reason why that matters. If you take a look at this down here, I just updated the information with the trade so you can see what happened. And essentially, I've taken the basis adjustment down by 3.6%. I've reduced the cash secured requirement for the trade by $600. Not much, but again, on something that's only 44K allocated, it's not a trivial amount of money. And really, we need this to be trading. We need this option right here to be trading at 281 before we hit our break even, where we could prospectively close this trade and then move on, with a profit without taking it all the way to expiration. Again, this is why understanding rolling options is so important. I have a video, I'll link to that in the notes below, that talks about it, because this number matters a lot. You don't have to take this all the way to expiration, and I don't intend to. Cool. So now let's take a look at UPRO. UPRO was a little bit of the same. So we can see that there was actually 2 tranches that got adjusted today, a 6 lot and a 3 lot, and then also the short call side of things. We'll start with the short call because that's easier. From the short call side of things, I literally just took them down. I had the 102s that were a 30 delta 21 Feb, took them in for 40 cents. So that gave me $145. And then I offered one more. So same lot size, same expiration, but I just took them in further to the 95s, which are 22 delta. The 95 is still above my basis by just a little bit, but this allows me to increase my total premium without adding size on the call side of things. I still have 100 shares that are uncapped, too early to cap those. And then on the put side, we did have to play some games. So on the put side of things, this is what came down today. I had the 90s out, both for 17 Jan, the 90s and the 88s. I sold them for 180, 165 respectively, and then I took them in for 560, 410 respectively. So you can see that that brings the realized P&L on the put side of things to negative 2802. This is again why rolling options is important to pay attention to, because this, even though it shows negative, I do have enough to overcome that loss. However, this is realized. This is unrealized. These trades are open. They can turn against me even more, forcing me to make even more adjustments. But what I ended up doing was taking the 90s to 86s and then the 88s to 85s. They're both in 21 Feb. They're 50 delta, 46 delta. So I was actually able to put these out essentially right at the money, which is great. It's a great basis adjustment because these were both in the money at the time of adjusting. So had a really healthy move on the overall basis. So again, showing you those metrics down here on the 6 lot, we were able to reduce our basis by 4.4%. And then we reduced total cash secured requirement by $2,400. Every time this happens, we're reducing total risk, which is good. And then on the 3 lot, we reduced that by 3.4%. Again, took down $900 of risk. So now we're just hanging out. This is where both of these sit today. Now, from an analysis perspective, I'm going to conduct the analysis on the underlying itself, meaning SPY versus UPRO, just because this is the dominant index that it's based off of. And I already explained most of my thoughts here, where I still expect more downside potential based on the broader trend that we're seeing here. And as long as this trend remains like this, I'm going to remain defensive in my positioning. So if we take a look at drawing like a basic trend line here, and then another trend line, really, it kind of starts from here-ish, but we're very clearly in a negative trend on these. This price level is really important, and we'll see how it behaves if it gets a rally. If it does rally, does it start approaching this? But with no rate cuts coming up and earnings coming up, unless earnings are smash out, everything looks good. This just generally looks like more room to the downside. And in Qs is even worse, because Qs is in a clearly defined downtrend at this point. And it has the broader, this isn't clicking for some reason, there we go, has the broader descending channel to show it. And this is already below this support. So not only does that not bode well for Qs, but that doesn't bode well for the broader market, because tech has been such a massive element propping things up. Futures are up right now, so it's a little early to tell. We'll take a dive into this stuff later today during the live stream, but wanted to give you a quick recap on what I saw, some trade adjustments. As always, if there's anything you want me to take a look at, a stock you want to analyze together, let me know. We can take care of that. Be an outlier. Let's go later.